Hey there, welcome back to another episode of the DGI Crab. My name is Colby, the DGI Crab. Today we are going to talk about what is an investor to do if they do not want to buy individual stocks but just want to focus in on ETFs. Maybe you're afraid of the idea of investing in individual companies and the added risk that that does in fact entail. Now, I do have the four tiers, which are individual growth stocks, sorted out by the appropriate age that I think you ought to be looking at them in, that I do think are as safe as individual company stocks can be, but there is some increased risk with stocks, and there's some increased time that has to be put in on your part in order to purchase those stocks at a time where they are showing undervaluation. Now, that's what this channel is about. I'd love to be able to be part of your investment journey and help you along the way to do just that. But if you're not really wanting to have all of those individual positions and you just want to know how to do this utilizing ETFs, you're in the right place. That is exactly what this video is about. Now, before I jump in, I do have to make that obligatory statement that I am not a licensed professional financial advisor. The opinions expressed in this video are just this one crab's opinion. So always do your own research, whether you're investing in stocks, ETFs, or anything else. But with that, let's just jump right in. So I'm going to break this down into age like I do with everything else. If you are between the ages of 18 and 32 and you are only going to hold ETFs, I think an appropriate breakdown is as follows. We'll be focusing in on four ETFs. So I've selected VOO, which is an S&P 500 ETF, and you could swap out the ETF that you'd prefer on any of these if you want to do SPY or IVY or some other S&P 500 fund. That's entirely up to you. But I think about a 60% allocation in the S&P 500 is certainly a good idea. You want to get some price appreciation, certainly some dividends as well, which you'll get with the S&P 500. But the idea here in this younger age range is to build up a nice, big, comfortable position in the S&P 500. S&P 500 grows historically by an average of 11% a year. And just doing some quick math, if you have $5,000 worth of S&P 500 by the time you are 22, then by the time you're 61, that should be worth about $300,000, assuming that you don't invest anything else into it between 22 and 61 except for the dividends. Not too bad. Not too bad. VBR, my favorite of the small cap funds, I'd put about 30% towards the small caps while you're younger. Get a nice amount of exposure to those smaller companies that are not part of the S&P 500. VIG, that's going to be your dividend growth fund. The purpose of VIG is increasing annual dividends year over year. Not a huge starting yield. You're usually going to get about 1.75 to 2% when you buy it. But the year over year dividend yield should grow by anywhere from 8 to 12% a year. So not a bad idea to at least kind of start the journey of dividend growth here. Not a ton, mostly S&P 500 and small cap, but you could at least kind of get started with something like VIG here. And then I think it's a great idea to have some international exposure. And my favorite international ETF is VYMI, the Vanguard High Dividend Yield International ETF. From age 33 to 54, you're probably going to switch it up here a little bit. You're going to switch your focus over to your dividend appreciation. Again, VIG is a really good one, and go with that being your 60% allocation. You're still going to be adding into the S&P 500. We still want to get that growth. Still want to get the exposure to all of those great tech companies that either don't pay much of a dividend at all or none, and get that price appreciation. We're going to shift our small cap down to just 5%. Still want to add some to the small caps, but that's certainly not the focus at this sort of middle age investor range. And then we will continue to do 5% into the international fund. And then next, from 45 to 54, we're going to introduce some new funds here. So I've picked VYM. That's going to give you qualified dividend income. Very low expense ratio, no real estate. So all the dividends that you're going to get from this fund are going to be tax advantaged, meaning no taxes up to the first $40,000 or $44,000 and change that you make in dividends. Then I'm going to add DHS to that also. DHS, similar to VYM in composition, but it is a monthly paying fund, which I think is just remarkably overvalued. Oh, but what about SCHD? SCHD is the best out of all of them. Well, fine, you can have your SCHD in place of either VYM or DHS if you like that one better. Not here to argue about which one's the best. This is all about strategizing for the type of fund that's the best for your age range. Now, I'm going to go with 5% into DIVO, which is also going to pay me out monthly. Usually it's going to yield anywhere from like 4.5% to maybe 6%. And it has shown that it can appreciate in share price as well, which a lot of the other covered call sort of funds up to this point just don't really have that price appreciation going for them historically that I have seen. If you've seen one that has a longer history than DIVO and as good or better price appreciation, then leave that sucker down in the comments because I'd like to know about it. And again, still going to go with that 5% towards our international exposure and just kind of keep gradually and slowly building that thing up. And then for 55 plus, there's a lot of different ways that you could go here. For 55 plus, I'm actually spreading this out over 8 different ETFs. Now, I know that you're going to say that that's really complicated, and you certainly don't have to go as complicated as this, but if you've gone through a similar strategy as this leading up to this point, there are some things in here that you don't have exposure to yet that wouldn't be a bad idea looking at. So first off, we're going to go 35% each into DHS to continue to get the qualified monthly income. We're going to add SPYD to the mix, which has the highest yielding 80 stocks in the S&P 500. Typically, there's going to be a fair amount of real estate in this fund, which we haven't been buying real estate stocks up to this point with the previous ETFs. So not a bad idea to get a little exposure to that sector. And SPYD is just a nice high yield, fairly low growth, but consistent fund with a very low expense ratio and a very straightforward strategy. You know exactly what you're getting with this fund. And I'm going to keep going 5% into DIVO because, again, I like the combination of monthly payments, pretty decent starting yield, and the price appreciation. But I will go ahead and add JEPI to this one, JEPI, the JP Morgan S&P 500 covered call ETF. It's been a pretty consistent performer thus far, higher starting yield than DIVO, probably nowhere near as much price appreciation, but should be a pretty consistent play that could yield anywhere from 7 to maybe even 11%, depending on what's going on in the market and how many of those covered call options they're writing get bought. I'm going to do 5% into SPHY, a very low expense ratio, high yield bond fund. And we haven't done bonds up to this point. Not a big fan of bonds, but once you get into this age, you want to have something that's fairly stable, gives you a nice high starting yield, and I do like that it pays out monthly. MLPX is going to give you exposure to master limited partnerships, which are high yielding energy investments that come with K1 tax forms, which are a major pain. They will complicate your taxes. And if you've got a tax professional on your side, then maybe that's not going to be a huge deal for you, and he or she isn't going to mind dealing with that K1. But this is ETFs, right? So we're not buying individual stocks here, and this ETF does not require you to have a K1 form with your taxes, and it is just going to give you exposure to the broad MLP market. And I think a little 5% allocation here to something that you haven't invested in up to this point, certainly not a bad idea. PFFA is an ETF that holds preferred shares, which are different than common shares of stock. They're typically higher yielding, less volatile. They're not something that I personally know a ton about in terms of acquiring them, when to acquire them, so on and so forth. This is a pretty well diversified ETF that usually has between 175 to 200 holdings in it. It's a very high yielding monthly paying ETF, bit of a higher expense ratio, but if you want some exposure to preferred shares and get that higher starting yield, that higher starting income, this is a nice way to get it without having to go through the hassle of learning an extra layer of things. Because guess what? If you don't want to learn about how to acquire single common shares of stock, I guarantee you don't want to learn about preferred shares. So think about a 5% allocation. Seems like a pretty reasonable idea to me. And then we're going to wrap that up, staying consistent with that international high dividend yielding VYMI for our international dividend exposure. So that is my personal opinion on a good breakdown of how to approach being a dividend growth investor by age range if you're only going to be purchasing ETFs. Certainly not a bad idea if you do not want to put in the time or the research to and keeping track of a bunch of different individual companies, how they're performing, when a good time it is to acquire them. Just dollar cost averaging into ETFs every week, every couple of weeks, every month, however often that you invest. This is going to give you a tremendous amount of diversification. You should know exactly what it is that you are investing in generally with each one, and can have some confidence in knowing that your strategy for your age range is going to make a lot of sense. So this is just one crab's opinion, but I think it's a pretty good one, and I'm confident in it. If you've got some better ideas, give me some feedback below. Email me your questions at dgicrab@yahoo.com, and I will have some links to some other helpful videos on the channel below in the description. So please go and check those out, and I will see you on the next video. Keep investing, everyone.